Hey guys, Whitney here. Welcome to another episode of the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education at passiveinvesting.com. And we do this show live every Tuesday to help you learn the ins and outs of passive investing. Now, today's topic, we're going to talk about earn more while you wait. I know a lot of investors are trying to figure out what on earth is happening in the market today. They're trying to wait out volatility. They're trying to wait out tariffs. They're trying to wait out possibly interest rates falling, which we've already talked about, why they may or may not fall in the next few months. So there's a lot of people sitting on the sideline, but we want to actually have our money working for us. And part of that means we have to have liquidity. So we're going to talk about liquidity strategies for passive real estate investors. What can you be doing right now while you are trying to figure out how to deploy capital in your next passive real estate deal? Now, if this is your first time joining, you're in the right place. If you want to learn how to turn your active income and savings into passive income and long-term wealth. Maybe you've tried investing before, but just couldn't get comfortable making the investment, or you've actually invested in a deal before and went, oops, I made a mistake. Or you just simply want to sharpen your skills or even pivot your portfolio strategy. If that is you, you're in the right place. Now, before we get started today, I want you, if this is the first time you and I are meeting, my name is Whitney Elkins-Hutten. If you're watching the video, you see a picture of me and my crazy crew. This is what we love doing, camping, exploring, traveling. And what has allowed us to do that is our investments. Now, we started off investing actively. I scaled a single family rental portfolio, did several millions in fix and flips. But what has allowed us to spend more time together as a family and travel and do all the cool things, and for me to be able to spend my time here with you, is our passive income that we generate from our investments. And I get to work with you as my role of director of investor education here at passiveinvesting.com. I do coach people at ashwealth.com. I've documented my journey in my book, Money for Tomorrow, How to Build and Protect Generational Wealth, which is not just for an new investor or somebody who's inspiring to build a portfolio, but if you've built and scaled a portfolio and you're kind of like, it's not really standing the test of time in today's markets, check out my book. There's probably a foundational pillar, a money pillar that you're missing. Now, all of this to say, all of my work is to help you drive a similar result that I have, which is how do you have 100% choice and control on how you spend your time? And we can help you do that here at passiveinvesting.com, whether it's through our equity investments in multifamily self-storage or express car washes, or in our cash flowing real estate investments in our real estate debt fund. We can help you do that. So be sure to join the Passive Investing Club. You can join at passiveinvestingwithwhitney.com. There you can get priority access to our deals, schedule one-on-one time with me to discuss your goals and how we can help you meet them. And then, of course, you get access to all of our free resources. Now, today, we're going to be talking about, how can you be structuring part of your portfolio in order to not just navigate what's happening in the environment, but wait for the right time. How can you have patience, all right, but still earn a return? Now, what we talk about today is education only, as always. So it's not financial advice, legal advice, tax advice. Make sure to take this information back to your investing team. All right, so I want to debunk an investor myth. And that is, a lot of people are sitting on the sidelines saying, I cannot deploy my capital because what if I find an equity deal that I really like in the next 2, 4, 6 months, right? It's just not worth it. I'll keep it in the bank. And the thing is the answer to this is actually having a liquidity strategy built into your portfolio will help you earn more than you ever could keeping your cash stagnant in the bank. So let's talk about what that liquidity strategy could be. Now, I want to redefine liquidity a little bit. Okay, so I'm all for, if you've been following me for a while, I'm all for making sure that we have reserves sitting in the bank. Okay, that's fine. That's our, oxygen mask. That's going to help us, if times get tough, like maybe you're still employed, you're working a job, and you need to have your income still coming in. That's going to help us pay all those bills. Okay, that we're going to leave highly accessible, say like in the bank or in a money market. Okay, leave that there. Everything past that, we can do something with. Okay. Now, where a lot of investors have gotten in a bit of trouble in the past like 2, 3 years is that they got really tied up, right? They were investment rich but cash poor. They had poor liquidity structure within their portfolio. Now, I think, the pendulum swayed really hard the other direction. And a lot of people started just stashing cash in the bank. Okay. And I understand it feels safe. Okay. But in today's market, you're probably earning 3 to 3.5, percent on that cash. If you're in, I bank at Ally, I think in my high yield savings account, I get 3.6. Now, let's assume that you're in an amazing high yield savings account and you're getting 3.6 on your cash. Are you really getting 3.6? I challenge that because now we got to take into account two large wealth eroders. The first one applies to everybody. Well, both of them apply to everybody, but the first one is taxes. Okay. So if we assume your marginal tax rate, you're probably earning not just 3.6 on the cash, but closer to the 2.29. Okay. Now that, 3.6, 2.29, we're still in single digit returns. Okay. It doesn't feel that big of a hit. But in reality, you took a 36.4 decrease in return on your cash. All right. Now remember, this is not cash that you have to keep 100% safe, but you do need to keep it liquid for one reason or another because you're looking for an investment. Okay, but taxes is not the only eroder that we have here. We have another erosion power, which is inflation. All right. I looked up May's inflation numbers, May 2025, it was 2.4%. Now, just a few months ago, we were up in the 4 and 5%. So inflation, year over year inflation is stabilizing. All right, guys, it's not coming down. That's a different story. If it were coming down, we would be below last year's numbers. Okay, we're just stabilizing at that 2 to 3% the Fed fund or the Federal Reserve is trying to target. All right, so we have to account for taxes. That drops us to 2.29. If we account for inflation, all right, our purchasing power went from 3.6% real return on our money now down to negative 0.11. So we're still losing money in the bank. That is our real return by holding cash in the bank. So the result is we have a lost opportunity here. Okay. Now remember, this is not our reserves. Okay. This is cash that we are looking to deploy. So when we're shopping for our next investment, and maybe our next investment is a debt investment, what if I told you there was a place that you could keep your cash, beat taxation, beat erosion power of inflation, keep it liquid, and oh yeah, earn while you wait, right? So let's talk about that. All right. Now, I want to make sure that, you understand the different layers of liquidity. I'm talking about capital liquidity, cash flow liquidity, as well as portfolio agility. This is what we're trying to combo together, while we wait for potentially a larger investment, okay, or more growth investment to come along. So cash flow liquidity, that's where we're getting paid cash flow, coming in monthly or quarterly while we wait. Now, we also want to seek out an investment that gives us capital liquidity, right? Meaning that we can actually get access to our money, call it due, and get it back in a very short time period if we need it, all right? And then the third type of liquidity here is that we want to seek out an investment that allows us portfolio agility, meaning that we can actually build up dry powder on the sideline while we wait for that right equity deal. Now, here's the thing. let's say you keep your money in the bank. You get cash flow liquidity, you get capital liquidity, but you don't have much portfolio agility. It's not doing much for your portfolio. You're losing. Holding cash in the bank, you got a loser in quote unquote investment sitting on your balance sheet. Right? So we want to make sure that we're looking for things that combined all three of these types of liquidity together for you. Okay, so the outcome that we need to seek is that we need to have stable cash flow. We need to be able to have the freedom to act fast. And we don't necessarily want to go try to, get in a high risk investment where we could sacrifice our capital. Okay, we're not trying to win the lottery here. We're just trying to create portfolio agility to where we're earning while we wait. All right, now why haven't more investors, inserted a liquidity layer, into their portfolio? Okay, that would allow them to continue to be patient, to earn while they wait. Well, I think, over the past few years, what I see when I coach investors, I see two different things. One, we've got somebody who's just too conservative. There's a lot of fear. Maybe something has happened within their portfolio, or maybe they're nearing retirement and they're seeing what's happening in the larger equities market in general, and they just don't want to make a mistake. Okay, so they swing really hard to the conservative side. Or somebody is just being too aggressive with their portfolio, meaning they're, either in an accumulation phase and they're willing to take high risk, high reward positions, or they're just overwhelmed by all the options out there that they're trying to find that aggressive investment as opposed to taking the one that's right in front of them that can help them be more selective with their next investment. So how do we earn while we wait? There's different options for us, right? I'm going to talk to you about real estate debt as one of those options, but that's not the only option in front of us. Okay, so remember, we got our tiers stack. Okay, this is something that I've been working on in my portfolio that I've been educating you as our investors to mimic, figure out which layer you don't have in your portfolio, insert that layer. The first layer is the tier one layer, emergency reserves. Keep that in the bank, high yield savings account, money market, keep it super, super liquid, right? That is not the get rich layer. That is keep you safe layer. But then everything, once we have that 3, 6, 9, 12-month emergency reserve, whatever's appropriate for you, everything past that is liquidity that we can invest. Now, I really encourage people, make sure what the market is giving us right now is debt. How can we take advantage and invest in debt? That stabilized cash flowing layer. That's our tier 2A, as I call it. Okay, that's where we can even deploy some of our investment reserves here. We can actually allow it to compound and give us a cash builder type layer. And so here we're going to earn somewhere between 6 to 10% if we're just, want 100% liquidity. If we're okay with locking it up a little bit, we can maybe get 10, 12, maybe upwards to 14%. Okay. Then everything past that is going to be growth and equity or a hedge, right? These are going to be more of your speculative type investments, all right? Where I tend to target 13% or above for my speculative investments. We're locking it up for 3, 5, 7, maybe even 10 years. We're expecting not only, we might get cash flow, maybe, but I'm probably, gunning for some sort of growth component, tax component, all right? So here's the thing. As I look at scaling my portfolio, I'm not necessarily expecting one investment to be my liquidity, to be my cash flow, to give me growth, to give me tax benefits, and to hedge. All right. I can get that with an investment, but when I look at portfolio resiliency, I'm not expecting that. So take a look at what layer you're missing. All right. For most people, and for today's conversation, we're looking at that tier 2A, that investment reserve. You got cash sitting on the sideline. What are you going to do with it while you wait for your next investment? Now, when we looked at those different tiers, did that look familiar? Okay, that probably looked like the capital stack. All right. All right. Our tier 1 reserves are going to be at the bottom layer. It's not even on the screen. Our tier 2 is going to be 2A is going to be the senior debt type cash flow layer. Our tier 2B is going to be our mezzanine debt layer where we're going to take a little bit more risk to get a little bit more reward. And then our tier 3 is going to flip into the preferred equity and common equity layers. All right, so what is my favorite investment right now that is allowing me to be super patient and wait for the right equity investment to come along? That is investing in real estate debt. And I'm not just talking about any debt position. I mean first position lien, very plain Jane, okay, type of investment. I like being in first position. I like single family residences because there's multiple exits for those type of the borrowers on those assets. You know, if they're doing fix and if we are lending to somebody that's doing fix and flip on a single family residence, they can flip it to a first time home buyer. They could flip it if they're an investor, they can flip it into their portfolio. They can flip it to another investor for a short-term rental. Heck, they might be able to flip it to an institutional buyer that is buying up single family homes, right? So they have multiple exit strategies. Whereas, other funds might be peppering in ground up development, multifamily type investments. Those all have different risk profiles, different longer timelines, and then fewer buyers in order for that borrower to exit their asset to. I'm also looking for a fund where it has multiple loans in the fund because, if I'm going to, take my liquidity, I want to know that it is well diversified. So I want it being diversified over multiple borrowers, multiple markets, multiple deals, and not just a few, like say 30, 50, 60. I want hundreds of loans in that portfolio. Okay. But most importantly, I want to have that flexibility. Can I get monthly cash flow if I want it? Or if I don't need it, can I allow that cash flow to compound? All right. Can I, again, use it as my tier 2A, my cash flow layer, or if you want it to grow faster to help you get to that deploying capital for that next investment, allow it to compound. All right. Now, again, I want to make sure that the default rate on this type of fund is super low. And industry standard default rate on real estate debt funds is 1 to 3%. Most funds are playing a numbers game, all right? They're not in it to manage the best business. They're in it to manage numbers. Why not do both? Okay. And so, look to invest in a debt fund that has a super low default rate. This is also going to indicate how well do they know their market, how large of a network they have to support their borrowers that they're lending to. Also, what is their internal processes to work with borrowers to figure out if their borrowers are in trouble before the borrower even knows. All right. Now, the last, and you guys, you can take a screenshot of this. This is a great way to kind of, ask those questions as you're evaluating debt funds. One of my favorite things about our debt fund is that, for the, 6 and 8% investment tier layers, there are no lockups, right? I can be holding my cash in the bank. I can earn a real return after accounting for taxes and inflation. And I don't have to lock up my money. I can stay 100% liquid. All right. Whereas other funds are going to, force you to be locked up for 6 months or 36 months. And then they've got long redemption periods. Okay. All right. Another way that I want to make sure that I'm protected. Remember, this is liquidity cash. This is, I want to make sure that I am keeping it safe for my next investment and I'm earning a real return. I don't want it levered. I don't want the fund taking out a line of credit from the bank and moving what I'm seeing on paper as being a first position lien fund and putting me as a limited partner now behind a bank line of credit where the bank can call their line due. All right. And then I want to make sure there's a very low break even number, meaning how many loans in that portfolio or what percentage of loans in the portfolio actually have to perform in order for me to get my return. Okay. And, a lot of funds are in that, 70, 75, 80% range. Okay. If we're moving through a recession, I'm not saying we're going to see a 20% dip in loan performance, but let's just say the fund does some high risk investments. in, say, ground up development, or I don't know, secondary notes, or um, multifamily. Okay, I should say, investments that are higher risk. And let's just say like one of them is a big loan, and that one large loan out of the 30 that are in the fund falters. Okay, now we're seeing, a huge drop in that break even number immediately. Whereas if you got a fund that has hundreds of loans in it, and every single loan is a nominal amount, say like $100,000, you know, we've got a lot more flexibility there. All right, guys. Now, this was just a little bit of a primer to help you look at real estate debt funds in general, but more importantly, our real estate debt fund here at passiveinvesting.com from a different lens, right? A lot of people are like trying to figure out, do I invest in equity or debt? Okay. Why not and? While you're trying to wait for that next equity investment, let's make sure your cash is put to use and is not being eroded by taxation and inflation. Earn while you wait does not have to be complicated. We want to be in that asset-backed debt fund. We want to avoid all the unnecessary risks. We want to get cash flow if we want it, or allow it to compound if we want it to grow. We want to make sure that we can get out of the fund with clear redemption and maturity terms. Most importantly, we want to earn more than what we could in the bank. Why not earn the bank's return? All right. Okay. Anyways, guys, if you're here live, we're going to move into the Ask Me Anything part of our show. But if you're joining us on our podcast, this is your invitation to join us at passiveinvesting.com. You can either scan the QR code if you're watching via video, or you can visit the website passiveinvestingwithwhitney.com.